Let me start off the discussion by trying to push you a little further to maybe quantify some of the outcomes. You made very clear your view that there is no strong evidence that financial institutions beyond a certain size are worthwhile and may even be too risky, the definition of SIFIs. Can you put any flesh on those bones in terms of magnitudes involved? What levels of size are you finding in your work, your analysis, and of your colleagues, go beyond socially desirable levels that suggest that they in particular are the ones who need to be addressed by the reforms you're discussing?
So for that, it's difficult to answer that question directly, in part because of a phenomenon I actually have described in a previous speech. There is, as I alluded to, there is remarkably little academic work on what I would call the intersection between industrial organization economics and finance. There's an awful lot written on finance, and heaven knows in the last 3 years, more than ever, and lots of finance professors are writing about systemic risk, both with respect to firms and instruments. IO, though, seems to not have addressed too head-on the complex kind of globally active financial institutions we have now. In fact, if you search through the literature that does exist, you'll find that a disproportionate amount of the IO and associated antitrust writing is on what I would describe as very conventional bank mergers between depository institutions in different markets. So many people, I think, have pointed out there's no evidence that some of the firms need to be as big and as complex as they are, even though I think everyone would agree that there are substantial economies of scale in addressing the needs of very large, sophisticated global clients, things like global payment systems and the like. But I guess the point is that in the absence of a demonstration that the enormous size and scope, which is bigger than it's ever been, is necessary in order to achieve true economies of scope and scale, many commentators have pointed out that there are funding type advantages that come with the perception of too big to fail. Those are social costs because of the misallocation of credit that results. And we know that there are substantial costs associated with the failure of such institutions. So there are some very clear entries on the cost side of the ledger and very uncertain entries on the benefit side of the ledger. I would not want to foreclose the possibility there are such benefits, but I don't think they've been demonstrated to this point. And where that dividing line between the obviously socially beneficial economy of scope or scale and the derived funding advantage from size is to be placed, I can't quantify that at this juncture. I'm not sure anybody else could.
So there's really no threshold, even taking a very conservative estimate of the variables you mentioned, no kind of threshold, $1 trillion of assets, e.g., beyond which it's pretty clear social benefits do not exceed costs?
I don't. So I think people would probably have intuitions, but as people in this building would know better than most, an intuition is not the same as an empirically verified study, and I think that people's intuitions probably drive some of their thinking about financial regulation, but you've got to go beyond intuition, I think, when you're actually in the business of putting together a financial regulatory regime.
All right, some people may want to come back to that. Let me turn to the policy response side. You very helpfully laid out alternative approaches to determining desirable capital ratios for SIFIs, and you preferred the extended impact approach. I think extended? Yeah, expected impact approach. And you said maybe those would lead to ratios 20 to more than 100% above Basel III requirements. For this audience, which as you said is sophisticated but not probably as deep into the details as you are, what would that translate into? What capital ratios would emerge from that?
Two things to say about that. One, so Basel III is 4.5% minimum plus the 2.5% conservation buffer for a total of 7. So you would add the percentage on top of that. The second thing, though, is
the 8.5 to 15.
Yeah, something like that. That's 14. That's right, something like that. But that, you know, as I noted, even in the expected impact methodology, the outcomes are sensitive to the initial assumptions, and there's some uncertainty around all of that. So we've got to be, and I think we are domestically, and our international colleagues are, mindful of those uncertainties, which obviously affects how you would end up setting the final requirement.
One more question, then we'll open it up. I know you're off to Frankfurt next week, talk about exactly these issues with your counterparts from the other main countries. Obviously, sensitivities, diplomatic requirements here. But could you talk a little bit about the different attitudes in key different countries? E.g., the Swiss have talked a lot about really big increases in capital ratios, given the peculiar situation of banks there that are much bigger than the countries in some sense. But how does the lineup look in terms of basic different views? Don't have to necessarily identify which countries take which, but what's the array of attitudes that you confront when you go into these discussions that at the end of the day, I guess, will determine how much congruence you can get among national standards?
So let me repeat first something I said in my prepared remarks, which is I think we, meaning the Basel Committee countries, have come quite some distance in the last year towards having more of a shared view on this issue of a global SIFI surcharge. In all honesty, when we were pushing for this a year ago, I wasn't certain how much interest beyond a couple of obvious countries would be elicited by this. But the more we talked about it, and the more central bankers and independent regulators from all of the Basel Committee countries addressed head-on this issue of, it wasn't called TARP in other countries, it was still taxpayer-backed assistance. And the more that was talked about and the more people focused on it, I think the more inclination there was to try to reach agreement. So there were lots of differences of views on how many factors, I alluded to that. Differences of views on how many global SIFIs there are. I alluded to that, although I think everyone's agreed that once we're done with global SIFIs, there'll be some attention to so-called national SIFIs. Obviously, as you would predict, differences in how to calibrate, and those still exist as well. But I think there's been a general convergence, as I say, particularly by those who actually have to regulate these institutions and would have to deal with their insolvency, that the systemic risks are significant and that we need a macroprudential tool. I'm not going to try to disaggregate everybody's views beyond saying that you're right. There are some countries in which the size of their firms is so large relative to GDP that they may feel the need to have something above and beyond what we're doing as a global matter, which is quite justifiable, obviously, under those circumstances. But beyond that, I think people's views have been shifting, and this has been, as many international discussions are, an exercise in maybe people having some initial disagreements and finding some more convergence over time, and that's why I struck a relatively optimistic note about the prospects for for agreement sometime between now and the fall.
Let me just ask one more question following on that. In the book you did for us on Basel II, you included a very sophisticated analysis of the process through which the Basel Committee had worked. Took a long time to reach Basel II. You had a lot of critical remarks on the nature of the institutional process, and you drew constructive lessons from that. Now that you've been in the middle of it for a couple of years, what's your sense? Is it improving a lot? Is it adequate at this point? Still more institutional reform needed to put the process at the international level in a stronger position?
So first, first point to be made is the formal nature of these organizations is different from what it was even in the fall of 2008 when I completed that book in two important respects. One, the Basel Committee is now has got about double the membership in terms of countries that it did in 2008, a very salutary development, bringing in a number of emerging market countries, but it does mean it's a somewhat different dynamic, different organization. And two, what used to be the Financial Stability Forum has been transmuted into the Financial Stability Board with a more formal international structure intended to be an ongoing organization in which, if I can put it this way, holes in the international financial regulatory system that aren't covered by the Basel Committee or IOSCO or the insurance supervisors are identified and proposals developed to address those holes. And of course, that's a lot of what is going on with the resolution work, for example, in the Financial Stability Board. So the first point is, and the membership of the FSB is largely, though not completely, coincident with the Basel Committee. So we've got two organizations actively dealing in this area, and I would add IOSCO for a number of the derivatives-related activities as well. And they're bigger than they were before. I would say that some of the concerns that I had in 2008 are still with me today, and I'll return to those in a moment. But I think we've got some additional agenda items for shaping the system of international financial cooperation more effectively. One of those is we will need to rationalize meetings, if I can put it that way. I mean, it has been the case that sometimes there are 4 international meetings on essentially the same subject with called different committees, somewhat different cast of characters, although often from the same agencies. So it was almost inevitable in the wake of the crisis, with all the attention focused on these issues, and rightly so, that you'd have a kind of proliferation of activity. But I think we're probably getting to the point, and my guess would be after this G20 this year, where we probably need to do some rationalizing a little bit and say, okay, look, how in a sensible fashion, and from a selfish point of view that does not require me to be flying across the Atlantic with the regularity I have been, can we promote this, this agenda? Secondly, I mentioned that emerging market countries have been invited to and have joined, as well as a few others, the Basel Committee and the FSB. But I think it's imperative that we integrate those countries fully into the work of these and other committees. And that means several things. One, recognizing that the problems we and European countries and Japan and Canada and some other old line, if I can put it that way, old line industrialized countries have, are not necessarily the same as those in emerging market countries. And any international or financial stability board worth its name needs to be addressing the issues that are relevant for all of its members. Secondly, and this is maybe more personal.
Would you care to elaborate that, Dan? Because that's, I think, an important and interesting point. Just an example or two of concerns of primarily the newer emerging market members of the group that are not so much the old G7, G8?
Yeah, some of them, I mean, they vary, obviously, to some degree, but equally obviously, the kinds of global capital market activities that I described are not characteristic of even the largest financial firms in most of the emerging market countries. That's one example. Another, this is a slightly ironic twist to this one. Another is that in some of the requirements, for example, liquidity and other requirements, where there's a list of the instruments that are considered liquid, obviously government securities are included on that list. Well, a number of the emerging market countries running budget surpluses have pointed out to us that there does need to be a different set of instruments for their firms, since after all, they don't have plentiful sovereign debt out
Shame
there.
on them.
So it kind of goes in multiple directions. The other thing I'd say is I think it is really important to fully integrate not just the concerns of the new members, but to integrate the talent of the new members. And I guess by that I mean I think we all need to be more active in finding leadership opportunities for representatives from emerging market countries. It seems to me we've got enough committees now that there are plenty of leadership positions, and I think we have to migrate in that direction to make this a truly global financial stability exercise. You sit around the tables at these things, and you can just see how much talent there is, and you know, the fresh perspective that some of the emerging market country regulators and central bankers bring to a lot of our questions. We sometimes, you know, kind of get wrapped up in our issues, and we may be debating some of the finer points with some of our counterparts from the old line industrial countries. And then some central banker or regulator from one of the emerging market countries will sort of pipe up and say, yeah, but aren't you guys really talking about X? And everybody sort of sits back and say, yeah, that actually is what we're talking about. And I think we should harness that kind of insight and leadership into the organization.
Dan, I can't resist asking, are you thinking of the IMF?
No, I'm not speaking to that. I'm speaking to the organizations that I participate in, which except for every April when Meg Lunzinger is nice enough to let me use her offices at the fund to meet with my counterparts, the IMF is not one that I'm involved with.
I can't resist one more. Then we open it up. And this is drawing on your experience.
Fred paid for lunch, so he gets to ask all these questions.
To ask all these questions. Hopefully they're of broader interest. Drawing on your experience, which I mentioned in introducing you as the G7 Sherpa back in the Clinton period, and also in the transition back in the fall of 2008 when the G20 was getting going at the summit level. How do you find the interaction between the new mega global coordination process, the G20 summits, with your financial regulatory institutions, where right from the start, and given the genesis of the G20 summits with the financial crisis, there were directives coming from them to the FSF, now FSB, et cetera, to get with it on financial regulatory reform. Has that been helpful? Has that galvanized the process? How would you characterize the two-way interaction between the summits, kind of making broad policy declarations, and what you're involved in, as you described so thoroughly, in trying to implement it at the operational level? How does that work?
I think this one is a developing and changing relation. I think it's changed even in the 2.5 years or so that the dynamic has been in play. So. Look, I mean, you get a major global financial crisis, and in most of the world, or much of the world, an ensuing Great Recession. And obviously, this is and should be a central political issue. Political in the strongest, best sense of the word, which means something of interest to people in all of the polities represented on all these international bodies. So again, I think it was both inevitable and helpful that the leaders of the G20 countries were essentially, I think they were urging their own governments, their parliaments, their independent regulators within their countries, and their publics to focus on and take seriously and do something about the conditions and absence of appropriate regulation that allowed the financial crisis to develop. Summits, Fred, the interests shift over time. And again, they should. I mean, interests shift to the things that are front and center at that particular moment and that need the attention of leaders and that need some measure of understanding among leaders or finance ministries or in other contexts, foreign ministries. And so I think it's inevitable that just as in the US, attention is not so much on financial regulatory reform as it was a year or 2 years ago, so that's true globally. So, and that is why it's important to have those who are actually charged with the enactment of the regulation and the implementation of those regulations and the enforcement of those regulations to have robust international groups that continue to allow for the information exchange, for the mutual monitoring of implementation and the like. I think also it's just consonant with the fact that there's a very different set of domestic constitutional arrangements represented in the 24 or 27 countries that participate in one or another of these groups. So, just to take our example, in the United States, we have independent regulatory agencies that have delegated directly from Congress both the authority and the responsibility to achieve certain regulatory ends. So for example, Dodd-Frank, Section 165, tells the Federal Reserve Board, you guys do prudential standards and enforce them. And there are other areas in which we share that authority with the FDIC and the OCC. There are other rulemaking areas in which we now share that authority with the banking agencies, plus the SEC and the CFTC. In other countries, there are different domestic configurations, different degrees to which the regulators are wholly independent of, for example, the finance ministry, or maybe they have some constitutional relationship to the finance ministry. Those things all need to be mediated internationally in a manner that's consistent with everybody's domestic constitutional arrangements. And I think what the Financial Stability Board has done is to provide some mechanism, basis for everybody coming together and figuring out where and how everyone can put themselves in a position to take the requisite action without infringing on anybody's constitutional prerogatives.
Okay, I over-asked my questions, so let's open it up. Let me ask you to identify yourself and then fire away. We'll start up here.
Thank you, Governor. Charles Taylor from the Pew Charitable Trusts. Question about non-bank SIFIs. Mm-hmm. A lot of what you were talking about sounded banking focused, but I'm sure it was intended to extend to non-bank SIFIs, and I wonder if you could elaborate a bit on that. And also, in the international context, do you find that the Basel Forum as a bank-oriented group is able to provide that kind of elastic approach to thinking things through that will serve the larger interest of stabilizing the system at large?
All right, two good questions. So first, with respect to our domestic responsibilities here, as I suspect everyone knows, under Dodd-Frank, the Financial Stability Oversight Council has the authority and responsibility to identify and then designate systemically important institutions which are not bank holding companies. Once those institutions are designated by the FSOC, we, the Federal Reserve, then have the statutory obligation to supervise those institutions. What Dodd-Frank said, Dodd-Frank gives us discretion as to whether we will supervise the non-bank holding company SIFIs in just the same way that we supervise bank holding company SIFIs. I think with respect to capital, for example, our presumption would be, yeah, that's the same. It's the same set of requirements, but we will clearly be mindful of potential differences in structure, in the nature of activities that might make the application of, as you put it, bank-like capital standards inappropriate. Obviously, we don't know what the FSOC universe is going to be, so it's harder to get more granular than that. With respect to the international process, this is where I think, this is where the FSB has been a useful entity, among other ways, been a useful entity. Because on the FSOC are represented the relevant international standard setters. So IOSCO is represented, and the international IAIS, which I think is International Association of Insurance Supervisors, are also represented. They can and have brought to bear a perspective that is not bank-like necessarily, thinking in terms of large capital market-oriented institutions or large asset managers or obviously large insurance companies. And that's been a very helpful input, I think, both in terms of thinking about how one would adapt traditionally bank-like regulation to non-bank entities, but also filling in those gaps in the system as a whole. The last thing I'd say on that is we at the Fed have gotten an early start on some of this because, as you know, Dodd-Frank transfers to us authority or responsibility for supervising savings and loan holding companies, thrifts, a number of which are owned by large insurance companies. So that has focused us on the issues of large insurance companies where the insurance piece of the entire firm dwarfs the depository institution part of it, and so we've got to think of it somewhat differently there.
Okay. Charlie.
Thank you. I'm Charlie Schultz from Brookings. I have a relatively parochial question coming from a research institution. More than a year ago, you gave a very impressive testimony to the Congress on the data needs, analytic measures, models, etc., needed to do systematic monitoring of the financial system. You also put a pretty good bit of emphasis on the importance of making that data and analytic measures to the maximum extent possible subject to preserving proprietary data, make it public. And the presumption ought to be it should be public. And you went beyond that and said not aggregate, measures of individual bank exposures, kind of systemic exposures, ought to be made public so that investors and analysts could judge the liability, I mean the problems, the individual status of individual institutions, and thereby strengthen market discipline. Now, the regulatory community and the people that it regulates have a traditional history of being very, very wary of anything like this. And the whole idea of public availability of data generated heavily through the regulatory process is not something that's going to fit easily. And I'm wondering, in the year and a quarter since that testimony, you have any thoughts on the pessimistic or optimistic about the likelihood of getting your way?
All right, so Charlie, the question may come. You characterize it as parochial, I guess because guy at Brookings asked a question about data that might be available for research, but I actually don't think it's parochial at all for the following reasons. If we think about what's the central feature of financial institutions which dominates a lot of investor thinking, regulator thinking, academic thinking, and the like. it is the relative opaqueness of their balance sheets. What is it about the supervisory process that is different from what we think of as the regulatory process? And I mean to distinguish, regulation meaning you consider and act rules that are then enforced. The prudential supervisory process is an ongoing, but by its very nature, less public exercise in which, in our case, we've got a couple of dozen people resident in the headquarters of our largest financial institutions. And the thought has always been that serves this important purpose of staying on top of things that won't be addressed by a rule and seeing problems early and the like. Hasn't always worked out that way, but that's certainly been the motivation for it. Well, but that is not something which is can be scrutinized by academics and the public in the same way, say, that an EPA reg can be scrutinized by academics and the public. So I put all that together, and it seems to me that among other things in regulatory reform, we need a kind of agenda for openness and an agenda for transparency, which would have, from my point of view, two key aims. One aim is some of the penetration of that opaqueness of the institutions themselves. An imperative if market discipline is to be a genuine part of our regulatory construct. Counterparties cannot exercise effective discipline if they don't have a basis for judging exactly what the risks and exposures of the institution they're dealing with are. So they either have to price in a premium of some sort, or they rely upon the traditional assumption that government would be there to bail out the institutions. This is TARP again, if worse came to worse. If we want market discipline to be a real part of the financial regulatory system, we have to open things up. That is why I personally, and again, this predates my arrival at the Fed, have been a proponent of making, on a regular basis, certain kinds of supervisory information available to the public. That's why I was a strong proponent of the SCAP, the stress test, 2009 stress test results being made public. Now, there's a traditional, as you say, Charlie, there's a traditional inhibition in a lot of supervisors saying, oh, we don't want to create problems that aren't there by releasing information. And I understand that, but it does seem to me that we have to come to grips with the question of how market discipline will be a real piece of ongoing financial regulation. And I would also say that if you regularize something, it doesn't become this massive, critical watershed moment. So, when we released the stress test results in May of 2009, we're in the middle of a financial crisis, and this is the first time anything like this has been done. It is not surprising that there was, how shall I put this, considerable press interest in what we were doing, okay? And one is going to see that the first time you do just about anything new. But if one regularizes the kinds of information you put out, it becomes incremental rather than game-changing knowledge. And I think there will be more convergence with the kinds of assessments and analyses that analysts will do. Now, I should say, I am really, truly speaking for myself here. That is, this is not something on which the board has voted. It's not something, I can already feel some of the supervisory people around the system squirming a little bit as they hear that. We've had these discussions, and they are important discussions that need to be had. I'm just giving you my perspective and why I think one way or another, whether it's quite as granular as I might be inclined to, or whether it's a little bit more aggregated, one way or another, we need to get more of this information out as we regularize it. Second, on the other side, what it is that we're doing. I think, you know, the opaqueness applies to the supervisory process too, and what the Fed and the other prudential regulators do needs at some level to be exposed to those people in the public at think tanks and law schools and business schools and the like, who are in a position to offer some constructive criticism. It doesn't mean it's going to be right, okay, for sure it doesn't mean it's going to be right, but you need to listen to it, and you need to have those folks with enough information that they can give you some sort of helpful critique from the outside so that you don't become too insular in the way you think about your supervisory process. That's one of the several reasons why I made such a point of the notion that the metric for systemic risk needs to be transparent and replicable. It's so that, you know, somebody at the Yale School of Management who wants to do a paper on whether what we're doing is the best blend of nuance and simplicity is in a position to do that. I have to end with one little anecdote. So I've, you know, with my academic background, when I go around to cities for speeches or stuff like that, I try to meet with finance departments, groups of people from law schools, business schools, and the like. So Charlie, every single time I meet with a bunch of people who are finance professors, whatever I want the agenda to be, their agenda is always, hey, when can we get a hold of all that Fed data that you guys have?
But Dan, I think it should be added in support of your thesis that when you did make the results of the stress test public, the results were extremely positive. In fact, many people date the recovery from the crisis to that event. So that's at least one data point very strongly in support of your transparency.
I agree with that, Fred, but in fairness to those who have some reservations around this, they would say the following. They would say, first, suppose that moment had not been one. Markets were kind of receptive to some relatively good news at that moment because the markets had begun to come to that conclusion themselves. Secondly, though, they would say, yeah, but the other point is, if the news had been worse, a part of the SCAP program was Treasury standing there with the TARP saying, if necessary, we will inject additional amounts of TARP in order to stabilize these institutions. Now, you know, from our point, so there was that backstop, and of course we pushed a lot of the firms to raise additional capital anyway. But I think, again, in fairness to those who aren't quite where I am on this, I think those are two distinguishing points. My thinking, as I explained in my answer to Charlie, is that if you regularize enough, if you pay some attention to making sure that things aren't unduly sensitive to the business plan of the firm or something like that, we should be able to overcome it. But you do have to take that into account.
Mike?
Which mic? Oh, this mic.
This.
Mike Musa, Peterson Institute. Yes, thank you, Dan. An interesting remark. I always worry in these discussions that one should not make a relatively simple issue overly complex. And three issues actually arise in that regard. One, on the amount of capital. Of the 5 largest commercial banks in the United States in 2007, 3 of them saw the market value of their equity decline to levels inconsistent with their continued operation as viable financial intermediaries in late 2008. No doubt, capital was inadequate to absorb, common equity capital inadequate to absorb the losses associated with that stressful situation, and certainly not to meet the criterion. They had enough capital left to remain in more or less normal operating conditions. Suggest to me a reasonable conclusion is multiply by 2. You needed to absorb those losses and have as much capital left over as what you started with. I think you are somewhat below that in terms of the new capital standards, and I wonder why. Second, you note the emphasis on common equity, and I agree with that absolutely, but I wonder why you aren't even more forceful. At the height of the crisis, I invested in the trust preferred shares of 14 U.S. commercial banks, saying they're never going to force these guys to default on their obligations, and probably not force them even to defer interest payments, which is feasible under that type of security without creating an instance of default. I am happy to say that I received every single one of my dividends on those preferred hybrid shares, and that the market value of those shares today is substantially above what I paid for them at the time. I believe this demonstrates beyond the possibility of any reasonable dispute that in the largest financial crisis we've had since the Great Depression, trust preferred shares played no useful role in absorbing the losses of financial institutions. Common equity clearly did. Common equity holders, I know myself from my own experience, suffered very large losses in share value and dividend payments and so forth. Common equity is capital in a meaningful sense. These other things, I think, have been proved to be, in a great financial crisis, really essentially worthless, and that our regulatory agencies should be pushing that point forcefully, domestically, and internationally. Finally, a key question which you did not address in any great detail is, what is the social cost of additional capital located in the banking system? Mm-hmm. Recognizing that capital in the banking system is not bricks and mortar. It has no physical counterpart. There is no physical cost. It's risk-absorbing capital. So you're telling the Bank of America, issue 5 billion more common shares and use the proceeds of those shares to retire whatever you can of your corporate debt. That pushes up the amount of common equity and pushes down the amount of debt without any demand for physical resources. And the question is, why not do that? Or what is the social cost of making that type of requirement? Many economists believe that the social cost of additional bank capital is well approximated by zero.
Right. So first, I'm not sure I quite understand, Mike, the first critique, because, well, in a couple of respects, with one qualification. So Basel III, I mean, micro and macro are different motivations for different metrics for capital requirements, as I said. But obviously, as I also said, they both relate to the potential for failure of the firm. The Basel III exercise, I mean, you can't look at the Basel III exercise as simply raising, some people have said, oh, so it kind of raises from 4 to 7. That's not the right way to think about it at all. First off, if you think about it, what was the pre-crisis requirement? Effectively, requirement, not actual levels, effectively. You had to have at least 4% Tier 1 capital, of which more than half needed to be common equity, which meant 2.00001%. Okay, that was the requirement. Now, firms were in fact above that, but that was the requirement. The Basel III agreement still has a Tier 1 requirement, but obviously the focus now is on the common equity requirement, which effectively has gone from 2, a little over 2, that isn't where capital actually was, but that was the requirement, to 7, with the qualification that in a period of stress, that conservation buffer could be drawn down at the cost of restrictions on distributing capital. So it's a significant increase, in addition to which the Basel III agreement cleaned up some of, even in the common equity realm, some of the exceptions for things that were counted as common equity, but if you applied the strongest loss-absorbing requirement, they didn't really quite qualify. And then on top of that, the agreement on market risk substantially strengthened the risk weightings for some of the very things that were badly underweighted in the pre-crisis period. So in effective terms, I think raised the capital higher. As I said, we had a lot of data to do this, both internationally and domestically, and we used both historical loss experience for individual institutions and our analysis. The SCAP provided us the ability to do the stressed environment analysis. And we came out somewhere, our range, 7% was sort of at the lower end of our range, but it was within that range. Now, when you add the systemic piece to it and the desire to get even further down the probability of failure of those institutions, obviously you go above that. But while it wouldn't have been, if it had just been us, we probably would have had a higher number. But it came out in a reasonable position. With respect to TRUPS and all that, well, first off, Dodd-Frank has eliminated TRUPS as a capital source for the big institutions. So that's kind of not an issue anymore. I couldn't agree more on the common equity point. I mean, that's what I was alluding to earlier with this is one of the reasons why we're a little concerned about the potential use of COCOs as a form of systemic risk capital. I'm sure, well, I'm not sure. I know conceptually someone could draw up something that looked good. Whether practically you can find the right trigger is way less clear. But what I would be concerned about is once there's some sort of hybrid thing in there, you get what happened under Basel I happening again, which is death by 1,000 cuts. And pretty soon you look up and the capital isn't really loss absorbing capital anymore. On your last point, I know that some academics have argued that equity is free. I think, from our point of view, what is important is we're coming at it from the other direction, which is what do we need in order to create that significantly reduced possibility of failure, which will then make the financial system more stable and force cost internalization, social cost internalization by the largest, most complex firms of what they're doing. So that's the analysis that we've had. I did mention that I think the notion that equity is expensive is a very static concept because it obviously depends on the reason why equity is expensive, which in turn depends on leverage in the balance sheet and the like. But I think the most important point for present purposes is the way in which we're going to approach the surcharge is one that begins with the aim given to us by Dodd-Frank, with which, by the way, we agree as a conceptual matter, and I think many people do internationally as well.
Let me get a European view. Nicolas?
Thank you very much. Nicolas Véran, visiting fellow here at the Institute and also fellow at Bruegel in Brussels. I have a sort of two-pronged question following your very stimulating remarks on the SIFI's surcharge. One is you alluded to the fact that foreign financial intermediaries operating in the US would be subject to the new US regime. And could you tell us a bit more about how this will work and the sort of implementation challenges that you expect or don't expect with international partners? And the second question, perhaps at a broader level, is how do you, supposing there is success in the FSB discussion on SIFIs and says that an international regime is reached that is perhaps not exactly the same as in the US, but something broadly comparable, how do you expect this to affect the patterns of international financial integration and the shape and structure of the global financial system in a qualitative way? Thank you.
Obviously, I think a large part of the answer to your first question depends on the outcome of the Basel process. As you know, right now, financial firms operating within the United States, financial firms within the United States, are required to meet our capital standards. But any firm which is in a country which is itself Basel compliant is going to be meeting those capital standards at its global level. And so the same could well be true for institutions post whatever Basel agreement is reached on the SIFI capital surcharge issue. And that would obviously be quite a straightforward way to do it, and I think from many people's point of view, the simplest, cleanest way to do it. If for some reason that were not the case, or a firm didn't have, or you had a firm from another country which was not adhering to the SIFI capital standards and the like, that's when we have to think about how effectively we ensure that it is meeting those capital standards. And that's just something we'll figure out over time. It's something people at the Fed are thinking about right now with respect to all of these standards, because you do have this issue of the operations within the country are only a part of, obviously, the global operations of the bank itself, and we're not regulating the entire global institution. So that's, I'm sorry, what was your second question? Just to remind me briefly.
It was basically about the structural impact on the global financial system.
Oh yeah, so structural impact.
So it's a very broad question.
Yeah, I mean, I think, look, it is a broad question, and we're obviously in the middle of an adjustment from what was an unsustainable form of regulation domestically, internationally, form of operations, everything from the misuse of structured products to lack of transparency and other things, to some, what we hope will be, a more stable and efficient global system for allocating capital. I think that as we are able to reach agreement on some of the key things like microprudential capital standards or a macroprudential capital standard, derivatives, things surrounding derivatives trading like margin requirements and central clearing requirements and the like, I think that you, in some sense, are, of course, leveling the playing field, which everyone from every country is interested in, but you also are allowing integration that is economically defensible, economically productive to take place. And that would be a good desideratum. Beyond that, I can't purport to foretell what the financial system is going to look like in 10 years. I mean, it depends on a lot more than the requirements we're putting in place today.
Okay, final question, Jean-Marie.
Thank you. Little did you know that Governor Tarullo has an NGO fan club, but he does. And what I'd like to ask first, so I'd like to thank you first for the social impact of the financial decisions and the financial crises. That's welcome vocabulary. You spoke to the welcome at perspectives and talent that bringing in the emerging market economies brought to the FSB and to the G20, the finance ministers and so on. Think of all those countries not yet included. Now, this would require certainly different governance, but these are countries, even the low-income countries are impacted by decisions, but their perspectives and their voices are absolutely absent, and I'm wondering if there's a way they could be infiltrated through some of those working groups that are multiplying.
Sure. So, yeah, it is absolutely right. So even if, I would say the emerging market countries that are now in the FSB and the Basel Committee are, by and large, countries that have financial firms that are operating internationally. As I said earlier, they tend not to be the highly capital market-oriented types, or as much the universal bank types. They tend to be somewhat more conventional financial intermediaries, but they're still operating internationally. There is a whole, as Joe Marie says, there's scores of countries, by and large, they don't have financial institutions that are operating in lots of countries, but as she says, they are impacted by the rules that apply to other guys, and that's in two respects. One, there's a kind of and I'm not sure this should always be the case, by the way, but there sometimes is this sense of, well, if the Basel Committee is saying this, then if we want to be state-of-the-art, world-class regulators, we ought to do it. It's not clear to me that's right. I think Jerry Caprio's writing suggests circumstances in which it may well not be correct. But beyond that, capital flows, investments in, lending to those countries from the internationally active firms is going to be affected by the rules elsewhere. And if the rules are not fully and wisely informed by the actual credit or market risk associated with those exposures, then they're going to, not only might they adversely affect other countries, but they're kind of not well specified because they're not doing what they're supposed to do. So in part, for both of those reasons, I think, the FSB has developed a regional, what I think they call a regional outreach program, which is trying to do both, I think to some degree, both of those things, although the agenda is just developing, with the countries in each region of the world that are not represented on the FSB. And that, judging by my email traffic, that process is now underway, although I don't think yet hugely advanced in the sense, I don't think we've had like multiple meetings everywhere. But there is some consciousness of that, I think. The other thing I'd say, Joe Marie, is that the bank and the fund are represented on the FSB. And it is one of their responsibilities, I think, to speak for their entire membership, particularly sometimes to speak for members who may not be present. They don't really need to speak particularly for the United States because Kathy Casey and I are sitting there. But there are, as you say, many countries that are not sitting there. And in some cases, some aggregated perspectives are useful to bring to bear, and indeed they've done it. I mean, John Lipsky has done that on several occasions when he's come to some of these meetings.
Dan, I should know the answer to this question, but I don't. You and your colleague have. Is the speech available out here for people to pick up?
It should be, yes.
Okay, so it's a very deep and meaty speech.
I saved the deep and meaty ones for the Peterson Institute.
Much appreciated. You can all get a copy on your way out if there's where they're supposed to be. Dan, we really deeply thank you for the deep and meaty presentation. As always, good luck in your continued efforts on this. Thanks to all of you for coming. Meeting adjourned.